You're listening to a production of the National Media Archive. To learn more or volunteer, go to nationalmediaarchive.com.
Have you walked past your local bank lately only to find the doors locked and the lights out? Last year alone, banks closed over 0 branches while opening just 1. That's a net loss of 2 places people once relied on for face-to-face service. You might wonder, why the rush to shut down so many branches? The answer is both simple and complex. Banks are chasing profitability in a fast-changing world. They're responding to what's called operational efficiency, cutting costs while maximizing output. Just like any business, if the numbers don't add up, the storefront can't stay open. But is it only about the bottom line, or is there more beneath the surface? Let me tell you a story. Remember the collapse of Silicon Valley Bank at the start of 2023? That wasn't just a headline, it triggered a domino effect. 3 more banks followed suit, and suddenly banking giants started rethinking their entire business models. Imagine steering a massive ship. You don't just swerve, you adjust course carefully. The technical term here is market adaptation. When banks face liquidity crunches and market volatility, they're forced to reallocate resources, often closing bricks-and-mortar branches to weather the storm. Now, you might be thinking, how does this affect me? Hold that thought, because it's not just a bank problem, it's a community issue. Here's a question. When was the last time you actually stepped inside a bank? If you can't remember, you're not alone. According to Bankrate, 27% of Americans now bank online, and another 75% are open to going digital next year. That's digital adoption at warp speed. The banks call this digital transformation, a fancy way of saying they're swapping tellers for technology. Sure, it saves them money, but what about us? Is convenience worth the loss of personal touch? Imagine needing help with a wire transfer and only having a chatbot to talk to. Is that progress or just penny pinching? Let's connect the dots. Since March 2022, the Federal Reserve's been hiking interest rates to fight inflation. That's the persistent rise in prices over time. But here's the twist. Higher rates make borrowing more expensive. This is called monetary tightening, a lever the Fed uses to cool things down. But for you and me, it means costlier loans and shrinking access to capital. You might think, if banks save money by closing branches, shouldn't we see some of those savings? Yet, checking account interest rates are flat, while credit card rates skyrocket. Where's our benefit in this equation? Banks are masters at reducing costs and maximizing profit. They call this risk management and cost optimization. By shutting down branches and going digital, they cut overhead, think rent, utilities, staffing. But here's a twist. What if we use the same playbook? If banks can pivot to stay liquid and profitable, shouldn't we do the same with our household finances? Imagine tracking every expense, cutting monthly subscriptions, and automating savings. You'd be surprised how quickly your personal profit margin can grow. So ask yourself, are you running your household like a thriving business or just hoping for the best? Let's break down how online banking actually works. At its core, it's just a digital platform of virtual branch in your pocket. You can transfer funds, pay bills, deposit checks, and monitor your finances from anywhere. The backbone here is encryption, scrambling your data so hackers can't read it. And then there's two-factor authentication, a digital bouncer asking for proof of identity. Sounds secure, right? But remember, while it's convenient, you're still relying on centralized systems that can go offline or be hacked. So is online banking the future or just a stepping stone to something better? Now, here's a curveball. What if you could be your own bank? Enter the Infinite Banking Concepta system using whole life insurance as your personal financial hub. Think of it like a savings account on steroids. You pay premiums, cash builds up, and you can borrow against it. The technical magic here? Cash value accumulation, it grows tax deferred. Plus, there's guaranteed interest, unlike the paltry rates from your checking account. Now, you might say, isn't whole life insurance just for death benefits? Actually, it's a dual-purpose tool. You get protection and a self-financing engine. Intrigued yet? Let's compare apples to apples. Traditional savings accounts versus whole life policies. With a savings account, you earn interest but barely enough to outpace inflation. With whole life, you earn a guaranteed rate and your cash value is shielded from market downturns. Here's where the analogy of liquidity comes in. Both accounts give you access to cash, But with whole life, you can also borrow against your policy without credit checks. Imagine calling your bank for a loan and being turned down due to your credit score. With a well-funded policy, your own funds are your collateral. That's financial autonomy. So, how do you reduce financial stress when banks keep raising rates? Don't rely on Thembe, your own lender. Here's the secret. Banks use your credit score snapshot of your borrowing history to determine loan rates. But with a whole life policy, the insurance company lends you money based on your cash value, not your credit. That's called non-recourse lending, no credit check, no lengthy approval. And often the interest rates are lower than typical personal loans. Imagine paying yourself back instead of a bank. Now that's keeping more money in your own pocket. You might be wondering, isn't all this too complicated? Actually, it's about taking control step by step. Start by tracking your expenses through budgeting apps, set spending alerts. Next, explore high-yield savings or whole-life policies if they fit your goals. Remember, personal finance is just like business finance. You want cash flow management and asset protection. Don't just complain about rising costs. Do something actionable. If you're ready to take the leap, research, consult experts, or even reach out for a tailored plan, because owning your financial future beats waiting for someone else to fix it.